Welcome back, you legends. I'm Dr. Khan. Let's get right into today's video. Today we had the CPI data come out, and what do you know? I need to give a big shout out to Steven Anastasio. This man does not miss. Right on the money yet again. We were expecting a headline CPI number of 3.7% and a core number of 4.3%. We got that exactly. What does that look like? Well, core numbers in line with expectation, headline above expectation. So CPI was hotter for the second month in a row. In fact, let's chart this out. Look at this, legends. Went from a bottom of 3% in May up to 3.2 in July and 3.7 in August. This is year over year. If we chart out the month over month, look at this, legends. This is the biggest jump in CPI since the 2022 bear market bottom of October. Look at this. This is the highest month over month increase in headline inflation, driven primarily by those rallies in commodities, specifically oil, which has been propped up by the Saudi and Russian governments cutting down production. This is the direct result. 0.6% month over month. If I take a look at the 5-year running month over month inflation numbers, it is the biggest jump really since early 2022. Now, this is a worrying trend, especially if we look at the year over year numbers, legends. It seems like inflation is actually accelerating. Will this prompt a response from the Fed next week? And this re-acceleration in the headline numbers are worrying because, legends, headline tends to lead the core number. Core numbers, the core component of CPI tends to be a lagging indicator, and core CPI is still declining. We got the lowest reading. We got the lowest year over year reading yet. It's at 4.3%. But the worry now is that this number could follow the headline number and re-accelerate. Will that prompt a response from the Fed? Well, let's look at what the market thinks the Fed is going to do. This is the Fed Watch tool, and this is the expectation for September. There's now a 97% chance, or odds, I should say, of no rate hike in September. This means that if the Fed actually hikes rates next week, the market will be shocked and will get a severe negative reaction because the market is only pricing in a 3% chance of a rate hike at the next meeting. If you take a look at November, odds at 40% the Fed will hike in November, 60% no hike in November. The last meeting is on the 13th of December. Often, legends, the Fed does not actually do much in December, but if they do, if we get some kind of Fed action in December, that will again be extremely negative for the market. Again, 40% odds of a rate hike, 60%, nearly 60%, no rate hike. So the market pretty much is saying that the Fed is lying because the Fed has actually forecasted at one more rate hike this year. They haven't announced when exactly, but the Fed dot plots do show one more rate hike this year. The market seems to think that the Fed is lying. I don't think the Fed is lying. I simply think the market is out of bounds. It's not in line with what the Fed is going to do. And the market is going to get slapped around. Whenever we get this upcoming rate hike, the market will get slapped around, whether that's next week in September or in the meeting following that in November 1st. Okay, so with all of that being said, I published this note in the pre-market session yesterday, not today, yesterday. I laid out my expectations. Now, I did expect a headline number of 3.7% and a core number of 4.3%. And I expected that to result in a sell-off in the market. Did that happen today? This is the 10-minute chart. Pretty much nothing happened today. I'm actually shocked. The market is basically flat. It did nothing. It produced this indecision doji candle, pretty much closed at the closing price of yesterday, slightly up, about half a dollar up, 0.12% up. So basically flat. So the market took this on the chin. It did not negatively react. Volume is down, so that's kind of a strange market reaction. This is one of the most bizarre market reactions I've ever seen to CPI. We had the biggest month-over-month jump since the October bottom, since this massive gap down on October 13th. By the way, legends, the bottom on October 13th happened as as we got that CPI number that morning. That was the highest CPI read in decades. That turned out to be the peak. The market was right. The market thought that was the peak. We did too. We actually called this bottom to the day, and the market rallied. Now, interestingly, look at this trend line. I want to pay attention to this trend line, legends, because notice we tagged it as the market bottomed in October. Then we tagged it again as the market bottomed following the Silicon Valley Bank collapse and the regional banking crisis. We haven't hit that support line since then. I think we need a huge fundamental market catalyst, a bearish catalyst, to hit this support line. I still think we will see 431 before the end of October. That's my expectation. 420 still on the table as well. In fact, if we look at seasonality, usually October forms a lower low versus September and August. So far in August, the low was 433 on the SPY. A lower low would be something like 430, maybe lower to 420. That's still possible. And then a higher low in November and a new uptrend starting in early November. I think the market will follow seasonality more or less. It's been following seasonality fairly well this year. Historically, we've been outperforming the market in pre-election years, but that's expected because we had such a nasty downtrend last year. Now, this is looking at seasonality into the end of the year. If I look at seasonality into next year is actually expected to be a very strong year early on in Q1. Then a period of weakness that lasts 6 months from March all the way into August, September, then another rally in Q3 and in Q4. That is usually the case, legends. We usually get a bottom just before the election results, then the market resumes its uptrend after the election. But if you notice, legends, most of the gains are expected in the pre-election year. So we saw most of those gains and we topped on the 30th of July. Between July and November, actually mid-December, the market usually moves sideways. A lot of chop, double bottoms, triple bottoms, lower lows and lower highs, very choppy, but mostly sideways. That's in line with this forecast that we're seeing, and it's pretty much in line with the idea that the market will continue to coil and coil and coil, finally maybe hit 431 or 420 by the end of October, form that critical bottom, and set a new uptrend and take out this prior high at 460 and potentially go back to revisit these all-time highs by the end of December, early January. Now, this is the long-term outlook. What about the short-term? Short-term still trapped between the resistance and the support line of this huge bull pennant. This is a bull pennant or a bull flag, whatever you want to call it. Huge flagpole. Market has been coiling within the confines of the support and resistance lines of the pennant. We're smack in the middle. We haven't hit support or resistance since the last couple of weeks. The market is now waiting on PPI tomorrow and the Fed interest rate decision September 20th. Again, based on seasonality, legends, in September, we tend to top around the 13th trading day of September. That is actually in line with that September meeting on September 20th. Look at this. The 13th bar is September 21st. The Fed meeting is on September 20th. And so we have two more catalysts to look out for: PPI tomorrow and the Fed interest rate decision September 20th. Based on what we're seeing from the Fed watch tool, it looks like the market is holding out hope that the Fed is actually done raising interest rates. There's a big question mark around that, legends. Huge question mark around that, because they've been painted in a corner. They cannot ignore this. Inflation is re-accelerating. Now, inflation is up 2 months in a row, and it's up big. It's nearly a whole percentage point just in a couple of months. I don't think they can ignore that. When the market is so out of line with the Fed tends to follow the market. Now, the market is pricing in 97% chance of no hike at the upcoming meeting. So I don't think the Fed will surprise the market. The Fed does not like to do that. And so most likely what will happen is that the Fed will not raise rates at the upcoming meeting. Instead, they will forecast, potentially hint at a forthcoming rate hike either in November or December, and they'll do that at the next meeting. They need to do that because these odds are again out of whack. They need to be at least 60, 70, 80% in favor of rate hike in November and in December. The majority of the market now is pricing in no rate hikes at all the way to the end of the year. And if the Fed wants to take control of the narrative, they have no choice but to guide, hint at potentially another rate hike. They might say something like, okay, if CPI, if headline CPI goes up again, for example, in September, we'll strongly consider hiking again. Maybe they'll say something like, okay, if the core number is flat in September, or if it goes up, we will consider hiking. And the market will price that in immediately. Okay, in terms of tomorrow, PPI, the market is pricing in a $3 move in either direction. That again puts us in this range. Let's draw it out. Let's use the horizontal line tool. We close at 446.5. That means 443.5 to the downside, and to the upside, we're looking at 449.5. So this is the expected move for tomorrow. Today, the market moved less than the expected move. That's very interesting. I expected a huge move today. I think a lot of people expected a huge move today. I think the move today disappointed both the bulls and the bears. I don't mind that. I did not open any positions yesterday. In fact, I took some profit off the table yesterday in one of our positions. I closed that yesterday, nearly up 100% on that position. Close it out. And I'm now looking at building on top of my core long position, in some of my absolute favorite setups. Again, legends, all of my trading setups, all of my trades, all of my investments, I share all of that in real time in the trading community. So at the expectation tomorrow, if CPI surprised to the upside and the market did not really bust a move like that, we'll need to see a big move tomorrow, either to the upside or to the downside. We need to see a decision being made. The market has not yet made a decision. And if we just continue to move sideways into September 20th, that'll just be annoying. Honestly, that just annoy everybody. We need to see either a move to the upside, maybe park at resistance ahead of the Fed meeting, or maybe park at support ahead of the Fed meeting. Either one will be fine. If we end up at resistance before the meeting, we will likely see a sell-off. But so far, we're getting volatility contraction, right? Big down move, smaller up move, smaller down move, smaller up move, even smaller down move. Do you see that pattern? Perfect volatility contraction pattern. These patterns always break out. The market will not just move sideways all the way to the end of the year. That's not going to happen. We'll either get a breakout or a breakdown, and that will need to happen pretty soon. Based on seasonality, we usually get a breakdown on September 20th. So the SPY daily chart is not helping us, so we need to look at a plethora of other charts. Let's actually look at something like the VIX. This is the VIX hourly chart. We had this short-term support line. It broke today. The VIX broke it, and we had a slight rally in the VIX to win the day. It stopped again at that same prior support line, now resistance. So this does look like a bear flag in the VIX, and a bearish breakdown in the VIX will lead to a gap fill at 13. We're still waiting for that gap fill at 13. Now, the VIX is very strongly inversely correlated with the S&P 500. This is the S&P 500 down here. The last time the VIX was at 13, the S&P was at 453. So there's still a window of opportunity for the market to rally to 453 before the Fed meeting as the VIX continues to decline. More importantly, legends, as long as the VIX is declining, shorts and bearish positions in general in the market will struggle to turn a profit. As long as the VIX is declining, put options will lose value. Let me add back the S&P. Here it is. As long as the VIX is declining, really no shorts. You will not find anybody shorting the market as long as the VIX is declining, unless we're bottoming, unless we're forming bottoms like this. You'll see some people taking shots at shorting the market. Generally speaking, we don't like to short an uptrending market. We short a downtrend, not an uptrend. Picking tops is exceptionally difficult. I would dare to say it's nearly impossible to pick tops. Picking bottoms is much easier. With that said, look at this huge decline, attempted rally, failed at the 50-day moving average. We're now flagging, forming a bear flag, and it broke today. Let's get a closer look. Here it is. As long as the VIX is trading below the 50-day moving average, this this green moving average, the market is in an uptrend. And as long as we're trading above it, the market is in a downtrend. I explained this at length in my recent videos. So what's been happening recently, we tried to break out, the VIX tried to break out, sellers failed to take control of the market, multiple rejection candles, the VIX told us, no, the market does not want to sell down any further, and we had a breakdown in the VIX then tried to rally again, formed a bear flag, broke down decisively today. So the VIX lost 5% today, even though the market is flat. Even though the market is flat. So the market did not rally, did not crash, but the VIX lost a lot of value, and that's the danger of shorting the market. Even if the market is flat and you're shorting via puts, you will have lost so much premium on those puts. That's why we don't like to short an uptrending market, and recently the market has been trending up. So even though the S&P 500 is not telling us much, the VIX is telling us more upside is likely, especially after that breakdown candle on a key event like CPI today. Smart money seems to have completely ignored today's hotter than expected headline CPI, and that's evidently clear if we take a look at the HYG, the smart money. Look at this legend. Smart money up top made a new high versus this prior high on September 8th. The market made a lower high. The smart money made a higher high today. Very large bullish candle. Now this looks like a bull flag and we broke out today. So the smart money completely ignored the hotter than expected CPI number and they bought the market today. So we have the VIX telling us, okay, sellers are not committing here. Smart money is actually buying, both leaning bullish ahead of that event next week and ahead of PPI tomorrow. What else do we have? Well, let's revisit the stock market breadth, the 200-day breadth. I discussed this chart yesterday because it was absolutely fascinating to me. The market sold down, but breadth expanded. Unfortunately, this chart has not updated yet. This is September 12th. We did not get the September 13th candle yet. This is one of the drawbacks of using TradingView. Sometimes these breadth charts take a while to update. I'll update you again tomorrow, legends. If you're part of the community, I'll post the updated version of this chart for you before the market open tomorrow, God willing. But based on what I'm seeing with my own eyes today, the Russell is down 0.6% while the S&P and the NASDAQ are both slightly up. This tells me that breadth is down. This tells me that breadth is down because the Russell 2000 has 2,000 components and it's down while the S&P and the NASDAQ are up. And they've been mostly driven higher by a handful of stocks. We have semiconductors up today. Tech is up. Google, Meta, Tesla, Amazon. The same stock, we saw those names claim back those declines. Very interesting setup on Tesla. Right now, I shared that in the trading community. Check that out if you missed it. It's in the trading setup section. I want to close this out with the NYSE summation index. The summation index is down again today. We did cross down after we completed a cross up. Unfortunately, this again produces a whipsaw signal and it opens the door for periods of nothing, sideways chop. Look at this, nothing, sideways chop. When we get a lot of whipsaws like this, the market usually just does nothing, moves sideways, and then eventually bottom and rally. Now, this actually aligns exceptionally well with seasonality. Why? Well, because seasonality tells us that we're now in a period of chop that will last 6 more weeks. 6 more weeks into the end of October. Into the end of October, we expect the market to continue to chop, do nothing, sell off in the last third of September, rally again at the beginning of October, sell off again, form a double bottom with a lower low in October, and that usually is the bottom for the year. Let's take a look at XLY divided by XLP, consumer discretionary divided by consumer staples. As long as this ratio is expanding, legends, the market is bullish. That's the reality. As long as this ratio chart is rallying, the market is taking on risk. Consumer discretionaries are outperforming consumer defensives. And usually we get rallies throughout these periods. Let's see, usually we get rallies throughout these periods. So far, since that breakout, the market has actually been rallying. And today we actually made a new 52-week high on this ratio chart. The PPO is still rising up, never went below the zero line. So the market is still uptrending despite all of this nasty chop. The market in the medium term is still trending up. If you found value in this video, slap that like button right in the face to help us out. If you watched till the end and you did not enjoy the video, I do thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.